Hello, my name is Christian Andres. I'm a professor of corporate finance at WHU, the Otto Beisheim School of Management in Germany. In this short video, I would like to talk about the relationship between the corona or COVID-19 crisis and financial markets and the economy at large. Because what has started as a primarily health crisis has by now become a fully fledged economic crisis. So I'm not a virologist nor an epidemiologist, I'm an economist. So I'm not going to be talking about the health-related issues. That's for other experts to discuss. But we need a little bit of background to understand why the economy will be hit or is already being hit relatively hard. So most of you have by now heard frequently about the concept of exponential growth. It is something that most people, or the human mind maybe, has a hard time understanding, because exponential growth is something that maybe some people in the finance industry or in technology, computer science are familiar with, because we compound interest, or if you want to use a computer science analogy, you know that the density of chips and memory increases really rapidly, processing power, that's exponential growth. So the problem with an infection that spreads, and spreads relatively quickly, exponentially, is that it needs to be contained really early, because once you've reached 80, 90, 100,000, and this is not really locally contained, concentrated, as it was the case in the Wuhan region in China, it is more or less impossible to contain, and it's going to infect the entire population. Why is this a problem? It is a problem because our health system will collapse. And this is why many people have now pushed governments to act relatively early. Problem is, we're behind the really early phase already. So if you assume that people get infected and entire societies get infected, the capacity that we will need for hospitals or intensive care even will be far exceeded by, well, who gets seriously infected. So acting early means that we flatten the curve so that we will not have treatment in the sense of a vaccine or a pill that helps cure, but that fewer people get infected at the same point in time so that we spread contagion over time. Again, this does not mean that fewer people get infected. It means that people get infected, but they get infected more slowly. So if we flatten the curve to this extent, it basically means that people can get treatment and the health system does not collapse. That's flattening the curve. And this is why many governments, because again, otherwise the hospitals will collapse and many people will die because they will not be treated well. So governments have been imposing fairly strong restrictions. Well, we call this social distancing. It means that shops are closed, that also fairs and conferences cannot take place, but even that factories get closed. So this has severe implications for both mom and pop shops, because if your restaurant is not open, you basically don't have any revenue. It's quite obvious, right? But also for factories, for larger companies, this has severe implications because people who do not work get lower income, they spend less. Plus, we have a phase of high uncertainty. But again, this is something that's really important, which is why governments, Mrs. Merkel, yesterday addressed the German nation and said that we're facing the largest challenge since World War II. Emmanuel Macron, the president of France, and Andrew Cuomo, the governor of New York, have both said, well, we're at war. So this is a pretty strong shock to the economy if everything is closed down, but not everybody is affected similarly. So we talked about restaurants, I mentioned restaurants, and other entertainment, sports, and so on. This is, of course, severe immediate impacts. But some industries are hit less hard. There's even, well, Amazon is hiring, everything that's doing home delivery, groceries, even talk about expedited hiring, because they can't get people quickly enough. Nonetheless, in the grand scheme of things, there's estimates that GDP, by the standstill that we will observe, will decrease by 5 to 10% roughly. So again, the problem is we need to flatten the curve. This means we will spread it. What does spreading mean? It means shops and everything will be closed. This is not going to be a matter of weeks. It's more likely going to be a matter of 1, 2, maybe 3 months even. Right? So we will be facing a severe recession here. So what can we do about it? One way of approaching this is monetary policy. This means that central banks who set interest rates and find other ways of getting liquidity, money into the economy, take action. So the US Federal Reserve has, this past weekend, lowered interest rates to effectively zero and has also announced that they will be buying mortgage-backed securities and government bonds to the extent of roughly 800 billion US dollars. The ECB this morning took action in a similar fashion. Interest rates were already at zero in the Eurozone or even negative by launching a 750 billion bond buying program. So this is central banks creating incentives to invest by lowering interest rates. For investors, government debt becomes less interesting because you don't get any interest at all, even negative interest in the Eurozone, but also for consumers to take out loans because they get them on really good terms to buy houses, to, well, invest in goods, but also in, well, consuming more. The problem is right now, consumers who are facing a high degree of uncertainty, might even lose their jobs, will not invest much. Plus, investors are so concerned that they might not even buy corporate bonds, because debt is safer than equity. So if you shy away from risks, you want to buy debt instruments, not equity, not stock. But even in these high times of uncertainty, bonds are too risky, corporate bonds, for many investors, which is why the ECB is also buying these bonds that firms issue. So that's one aspect. But nonetheless, what we're seeing in these high periods of uncertainty is equity markets have plummeted. Again, not very surprisingly, because companies face the risk of, well, going out of business. But even for large companies, take Boeing as an example, a company that was already facing severe economic problems in the good times, right, are now hit even harder and will need government support. On the other hand, debt markets have remained calm for a long time. So equity, again, that's stock that companies issue. Debt is, well, are different debt instruments that they issue. What you can see here is BBB, investment grade rated debt. Markets have remained calm for a long time until last week, when also here yield spreads, so that's the risk premium that investors demand, skyrocketed. This is why it's really, really important for the Fed, the ECB, but all other central banks as well to take action, not only lower interest rates, but also to actively engage in buying bonds, which is, or used to be 10, 15 years, something that people would say, well, this must not happen. Why should the central bank act as an investor in companies? Well, they need to do it this time, and they're doing it big time. So where does all of this leave us? Where do we stand now? We do have a severe health crisis. We do have a supply chain crisis. Because, again, if what started in China, we see factories being shut down, Daimler, Tesla, other companies don't get the parts that they need, right? So there's insufficient supply because factories are closed down. But we also have a severe demand crisis. Why? Because people are laid off, they face uncertainty, and they cannot even buy, even if they want, because shops are closed, restaurants are closed. So we're going to see significantly less spending, and this ultimately leads to a stock market crisis. So that's a severe crisis. How is it different from the other crisis? Because again, as Merkel said, it's the biggest challenge since World War II. Other leaders have called this a war. This is different from the post-World War II era, because even though we, well, call this a war to make obvious how important it is to stay home, infrastructure is not destroyed, right? So we don't need to rebuild infrastructure here. But also it's very different from the financial crisis, where we had of course, severe problem that also came from Wall Street to what we said a Main Street problem, so that the real economy, as it was called, was hit. This is a problem that originated from the financial industry. This time around, the financial industry is, as far as we can tell now, still in a healthy financial state. Of course, if everybody defaults, financial industry also has a problem. But this is not the time in which you need to support governments, which is we saw with the European government debt crisis, or banks, at least hopefully not, at least not in the first step. This is a period where we need to take different measures, which is also why the Trumpian answer, which was first, well, we need to lower interest rates. Yes, sure, but this is only a small part of the problem. Governments need to make sure that this does not become a fully fledged labor market crisis. So in many the social democracies in Western Europe, people have fairly strong employment protection. In the US, for example, they don't, which means many people are laid off, which is why governments in the US and other markets where you have relatively low labor protection are considering sending out checks. So directly getting money into people's pockets so that the pain they feel from being laid off and the implications this has also for their healthcare coverage is somewhat mitigated. Payroll taxes will need to be deferred, but again, this is something that not everybody benefits from, because if you've just been laid off, the lower payroll tax doesn't help you much, right? Also, we do not have it yet, but governments need to make sure that we don't get a bond market crisis. Governments/central banks. This is why the ECB and the Fed has taken action, because what we need to prevent at almost all cost is that this extends to a housing market crisis. The housing market has recovered not only in the US, but also in European economies, Spain, Germany, the UK, France. Housing prices have increased significantly over the past couple of months and even years, right? And people fear there's already a bubble. If this bubble now bursts, on top of all the other problems that we have, we are in even more trouble. So what we need above all is confidence, which is why it's so important that governments act in concert, that they also reassure people we have a plan. Frankly speaking, it didn't help much that President Trump, but also the UK, Boris Johnson, for a long time didn't really have a plan of how to contain the virus, even said, well, this is not really a problem for us. And this is why then that the fact that the Federal Reserve in the US took action so quickly wasn't really reassuring markets, but was seen as something that even fueled uncertainty, because the idea was the Fed sees this as a significant problem, the president and the administration does not. So what's the matter here? We need leadership and action taken in concert. So at the end of the day, we need liquidity support through banks, low interest rates, encouraging them to give out loans to the economy. The problem is these bond buying programs of the ECB and the Fed do not reach the small mom and pop shops. So governments need to adopt different measures to get liquidity to these companies. So they're not closing, they're not laying off people that they would otherwise want to keep, because you're not only, well, in this case, you're not losing a production facility. That's not a war where something is destroyed, but human capital. Knowledge in your company might be destroyed if you lay off people that in the next couple of months find employment elsewhere. So we need liquidity support for companies and also small mom and pop shops. We need, of course, monetary policy. These are both short-term solutions that are needed. And in the long run, we also need the cure past World War II, which would be fiscal policy. You invest into infrastructure. You revitalize the economy by creating demand also from the government side. So we basically need everything that was used in the past to approach a crisis. Now we have a crisis in the order of the magnitude that it is a health crisis, again, a supply chain crisis, a demand crisis. And it's already a crisis in stock markets where investors are not willing to supply. So if firms need liquidity and they've run out of cash, they can turn to the equity markets or turn to the debt markets. Raising equity in these kinds of market environments is basically impossible. Raising debt is extremely difficult, in particular for small companies. So governments need to make sure through, deferring tax payments or finding other ways of getting money into the hands of small shop owners. And also they need to mitigate the effects on those who are being laid off. Monetary policy can do its part, but again, we need other mechanisms as well, like tax cuts and so on. And in the long run, fiscal policy. So I hope that this short video was able to put everything a little bit better into perspective in these very unusual times. Thank you very much. Bye-bye.